Welcome to Easy Accounting for All. I'm glad that you are here watching this second video in our series of 4. Like I mentioned before, I'll be walking you through the basic and important concepts for you to complement and understand accounting cycle. If you like this content, please subscribe to this channel and hit the notification bell. Thank you. Let's continue with the second lesson of 4. Lesson 2 of 4. In the previous video, we talked about the following concepts. What is accounting? The accounting cycle, the accounting equations, type of accounts, and nature of accounts. If you want to refresh about these concepts, let's go back to the lesson 1 or video number 1, and you're going to find the answers. In this video, I'm going to go over the following subjects: source document transactions, source document essential details, organize and classify the source document from the transactions, T accounts, debits and credits, journal entries and general journal entry, general ledgers, record transactions, and that's what we are going to see in the part. What is source documents? Source document is a physical or electronic document that provides evidence and details of a financial transaction. Source documents is the basis for recording the transaction in the books using specific accounts. In other words, from the source document, you can start doing bookkeeping. There are several types of source documents, and the most common ones are invoices, receipts, bank statements, checks and check stubs, credit notes or debit notes. I want to say about credit notes or debit notes, this basically modifies the original transaction, either way, from vendors or to vendors, or from customers or to customers. Contracts or agreements, sales order, purchase order, time cards. All source documents should include at least the following information: date, vendor business name, customer name. I want to say something about this. Not necessarily customer name is going to appear always. It is usually for certain business, but in a retail business like a grocery store, you go to buy two groceries, they don't ask you for your name. It could be they capture your name when you pay with electronic device like a debit card, credit card, etc. But usually this rule doesn't apply for that type of business. But you know who was the vendor. So anyway, that's what I want to clarify. But still, whatever you receive, any receipt that they give it to you, that's a source document. Description of the goods or service, usually that happens. Quantities, unit price, applicable taxes, and also the total amount or invoice total, or total amount or receipt total, okay, depending. Today days, especially when I go back to the grocery store, they give you a receipt, but the receipt looks like an invoice at the same time. Receipt because that proves that you pay, and at the same time, that has all this description except for the customer name. So that's what it is. For contracts or agreements, these details are usually written clearly in the contract itself. Sometimes additional details are provided in attached documents called exhibits, Exhibit A, Exhibit B, etc., which are part of the agreement. The source document should be organized and classified according to the type of transaction. It's very important to repeat this one: organize and classify. That's essential to start doing very efficient bookkeeping. Purchases from vendor or sales to customer may involve different categories and need to be classified properly to ensure accurate recording and detailed financial information is there. Examples for purchase invoices include general expenses, inventory or goods for sale, rent, lease payments, service, assets, freight, and many others. Yeah, definitely this is just a short list, but later on we are going to learn about more details, more concepts. Income or revenue transactions. So the previous one was the purchase, this is income or revenue. Sales to customer may involve different categories and need to be classified properly to ensure accurate recording and detailed financial information is provided, right? Example of sales invoices include retail sales invoice, wholesale invoice, online sales invoices, consulting service invoices, repairs and maintenance invoices, freelance or contractor invoices, subscription invoices, utility invoices, export invoices, right? Or import invoices, why not? Lease invoices, etc. Any other kind of transaction, but at least we have some ideas about type of invoices. And it is important to classify this one because in that way, your system is going to report at some point certain financial information or detailed financial information based on concepts. So you can be able to say our retail invoices, the total retail invoices, the total online invoices, etc. So depending the industry, you have to classify these type of concepts. So in that way you can break down where the numbers coming from or the component of these numbers. Think in this way, or think on this way. A sales invoice and purchase invoice are really the same document, and it is. It just depends on who you are. If you are the ones sending the invoice, you are the seller and that invoice represents income for you. If you are the one receiving it, you are the buyer and that invoice becomes a purchase for you. In other words, all the transactions involve two sides, a seller and a buyer. One seller, one buyer, at least. Let's talk about, very quick, about T accounts. T account is applied all the time in accounting. In a way, not many people use T accounts today. But I'm going to show you at some point in one of my videos, especially when we complete the exercise that we have, I'm going to show you how that looks in just T accounts. But in the meantime, I'm going to just go through the T accounts, how they appear in different journal entries or general journal entries or general ledger. A T account is a simple visual tool used in accounting to represent individual accounts. it is appearing in the journal entries and general ledger. Again, we are not going to see right now the full exercise, just T accounts, but we are going to see how the T accounts show up in the journal entries and general ledgers. Let's move on. The T account has two sides, left side and right side. And it's a T because it looks like a T. The left side of the T account is called debit side. The right side of the T account is called credit side. So we have debit side on the left side and credit side, the credit on the right side. Okay? So that's a T account. Each T account needs to have an individual account name title. Again, these T accounts, we are not going to develop that one because that's something that is very, very helpful to understand and to know. But at the end, we are going to do an exercise, or we're going to show the full exercise just in T accounts, using T accounts, like this. Because it has to have the name and the total activity. But that's something that it happens, but it's not usual today, except because the T account is still remaining in different reports. And I'm going to show you how that happened. Using T accounts help to visualize how debits and credits affect a specific account, making it easier to understand the flow of transactions in the double entry bookkeeping. It is very important to clarify here when I say double entry. Double entry means at least it has to be two lines, one transaction, two records. One transaction at least. It could be one transaction, any number of lines, the entries, 4, 5, 6 for just one transaction. But that's a concept that I want you to understand right now. So let's face this one. Let's go to journal entries. A journal entry is the first step to record a financial transaction in the accounting system, and it shows all the details from the transaction included. But before I said included, remember, we had a source document, we had to analyze, classify, and after we can just start do the journal entries or do the bookkeeping, or depending. If it's in accounting systems in computers, it's a different approach. But again, that's the same concept. So what the journal entries of the transactions include? Journal entry transaction number, right here. So journal entry transaction number, if you do manually by yourself, it would be a good idea just you to put numbers for each transaction that you are going to journalize. So that's going to be your journal entry. Now, in computerized systems, accounting systems, those softwares, usually they just are already set up to provide you a specific number. Each time that you do one journal entry, they assign a number. But it's very important to have the one. It's going to be one of the key to find transactions or to identify the journal entries. Transaction date, of course. The transaction date came out from the source document. That's right there. So you can just type it, the source document, okay, with that date. The accounts involve other transactions. Remember that we say you organize and analyze the transaction. When you analyze the transaction is when you decide what type of invoices are those belong to what account. So let's say this time we had an invoice or sort document that we buy inventory, and at the same time we pay for that inventory. So that's the transaction that you know already that you have to use two accounts. So that's why I use the inventory and bank account. Document number, of course, you have to put a document number, right? And right here we have a check number. I just put the invoice additional, but pretty much it's a check number. So that is going to identify the document that you pay and how do you pay, if that's the case. If you buy, let's see, you get just a credit from your vendor, so you don't have to use a check number. Probably you're going to use that invoice number. The brief description, detailed concepts, explanation for the transaction. Yeah, in this case, for this example, I just put that we purchased one engine from PFM. PFM is the vendor. So I just want to identify the one. The debit and credit side of the account entry. Yeah, I already did the account entry, right? So I put just 1,000 debit and 1,000 credit in the same journal entry. The debit and credit amounts, 1,000 and 1,000. Okay, this is a simple entry, so it's going to be just one debit and one credit. The total debits and credit that should be equal. Yeah, if you see here, we have the total debits is 1,000 and the total credit is 1,000. So if we have more activity, obviously that's going to be added to this journal entry, because by the way, in a journal entry you can add many transactions at once. There is no limit. At least the software has some limit, but there is no limit. You can put just hundreds of entries, but at the end, the total debits it should be equal to total credits. So let's review again. So we had a journal entry, we had the date, we had the account symbol, document number, brief description, we had the debits, and we had the credits, right? So in this journal entry, you will identify the application of the T accounts. And I want just to point that one. Do you see this T here in highlighted yellow? Yellow highlighted? This is the T account. Technically, this is the T account. Basically, it has two sides. Remember that we say the T account has a debit and credit. So this is the T. This line just separates the debits from the credits. And we are talking about right now everything about journal entries. In a journal entry, you can include as many accounts as necessary to accurately record a transaction. I already mentioned that one. This is just an example of two entries, right? But it can be hundreds of entries. So there you go. The single or simple entry involves two accounts. It has to be minimum two accounts in journal entry. It cannot be just one. Okay? That should not happen. It has to be at least two. But if it's more than two accounts involved in this one, is when we say that the journal entry is a compound journal entry. That means several transactions. And by the way, it could be just one transaction with a compound journal entry. Not necessarily it has to be different or multiple transactions. It can be just one transaction that has several concepts. Let's say that you have the merchandise, but the merchandise or the invoice, it has inventory, it has supplies, it has probably services or supply repairs or it could be has include taxes. So depending how do you um, manage your accounting, all those breakdown can be just in one journal entry. So that's what we call compound journal entry. Very important that the total debits and credits in the journal entry must be always equal. I already mentioned that. General journal entries are used to record transactions that don't fit into their specific journals. This is the different, when I say journal entries, let's say something. Most, especially in accounting computerized systems, they already have journal entries for in a specific transactions. If you do billing, when you do invoice, internally the computer is doing this journal entry, but you just have to go through the billing process. Or it could be has another option that say purchase. Okay, so it is specific for those transactions. So they set out to affect the accounts that are related with those specific transactions, right? Or could be has another one that say depreciation. Let's say depreciation. So many systems today days are set up with a specific journal entries that is part of the menu or options that you have, like a banking, accounts receivable, accounts payables, fixed assets, etc. But if you have that system and in that menu there is no an option for a specific thing that you have to do, like let's say you have to do an amortizations, and you don't have that one anywhere. So it could be in that system, you just have to use the one that say general journal entry. If that means it is for transactions that are not already set up in other options in that system. But in here, and just for the purpose of my exercise, we are going to do general journal entries for all our exercise. General ledgers. The general ledger is a detailed individual account report that shows all transactions recorded through journal entries. The common columns in the general ledger for each account are. Okay, let me go back to the general ledger. We were talking about journal entries. If you remember, we say inventory and banks. So what happened is, if you do, let's say that you're in Excel, so you have to technically copy that journal entry by accounts into one sheet that is called inventory, another sheet that is called bank, right? For the same journal, from the same journal entry. In a computerized system, you don't have to do that. That's automatic. Every time that you do journal entry and you decide what the account is going through, that is going to be posted there. So when you just decide to print out the general ledger, your inventory sheet is going to reflect all the activity in that account. Same for the bank in this case, for our example, but it's for all the accounts that you have working with based on your chart of account. And we are going to talk about chart of account later on. But let's see what is the parts that we have to consider for each general ledger. One of the columns is journal entry number. In our journal entry, I was talking about the journal entry, and I say that if you do manually, you have to, it's better you to assign one, but if you do through the computer using a accounting software, the accounting software usually provide you that number. So that's one of the things that is going to come to the general ledger. The second is the date. This came from the same journal entry that we did it before. It has to be the same information. Document number. This is the same document number that we had in our journal entry. Description or detail. This came out from the same that we put in the journal entry. It's nothing different there. Debit column. Same amount that we put in the journal entry is going to appear here in our general ledger. Credit column, same amounts is going to appear here. Account balance, this is something different. If you see in our journal entry, we don't have balances. Why? Because they combine several accounts. And here is the balance for an individual account. In our exercise, we use two accounts, inventory accounts and bank accounts. So the general area that we have right now available is inventory account and bank account. So that's the balance. And the balance is calculated every single time that you do a transaction. So that's something different. So let's say, let's assume something here. Let's say that we have another transaction here, general journal 002. And let's see that in that journal entry, we use $500 of our inventory. So if we put the $500 here, because we're supposed to do that, remember that when we were talking about assets, we say that the assets accounts increase with debit transactions and decrease with credit transactions. So if we put $500 here, my balance is going to be 500. So here my balance will be 500 because my total here can be 1,000 and here 500. So my balance is going to be 500. So in a general ledger, always the balance is updated after you input some transaction through the every specific journal entry or from the general journal entries. So that's very important. Besides that, I would like you to point here again. Do you see the T account here? Okay, it's going to stay there forever. It's not going to change this concept at all. It has been like that, I think it's more than 400 years that somebody created this concept. So I don't think so nobody is going to change this one ever in this life. Total debits, total credits, and account balance is the one that I already mentioned to you. Total debits, total credits, and account balance. So that's what we have to say is something about general ledger. Record transactions. Now that you know transactions are the starting point of the accounting cycle, and that this transaction needs to be classified and recorded using journal entries, or can be general journal entries, as I explained already, with debits and credits, because that's the standard procedure. Debits and credits that are part of the T accounts. We have also covered the basis of T accounts and how the general ledger is created. We already said the general ledger is a created based on journal entries or general journal entries. So now you know the fundamental concepts to start recording transactions. So I think at this point, we already have the ability to do transactions by ourselves. And I will guide you through the entire process in the upcoming exercise. So again, the exercise is going to be in Excel, because my goal here is you guys to understand how the computerized accounting software works. if you had that things as a plus in your life, it is going to be very easy for you to solve some problems that happen once in a while that came out from that software and you don't know how to fix those ones. So this is going to be a plus in your life, trust me. Remember, it's essential to consider. Look at the source documents, organize and classify. Decide which account will be affected. Apply the debits and credit concepts. Use the journal entries to record the transactions or the general journal entries. Review if review if the entries from the journal entry went through the general ledger account. And I say that especially because sometimes in the practical life, you just think that you just put in a certain account, and when you go to the general ledger, you can find that transaction. So you have to track in how you did it and go back to your journal entry and find out if you just put some account that looks similar what you expect to post that transaction. So that's very important. Okay, so just this is like a little summary about what we talk about today, or we have been talking. We have been talking about transaction, that the transaction is based on source documents, or the transaction provide you a source documents, and those documents has to be journalized, obviously, after you just organize and classify. And after you journalize that one, that information, that activity go to the general ledger, who is an independent account that show all the transactions that impact that account, only separate accounts. And from there, you can make a trial balance. So the trial balance is something that we are going to talk about later on in another video. And finally, we are going to go through the financial statements. When we get to that point of financial statement is when we say that we already complete the accounting cycle. So thank you for your attention. I hope this helped you in certain way. So see you in my next video.